G'day everyone, welcome to another roundup of global markets, and it was another week of gains, and the second week in a row since the mini panic, I guess, that we had in the early part of October. The rebound really has been just nothing short of spectacular, and it certainly points to the typical strength running into Christmas that we normally see at this time of the year. So let's have a look at what happened last week in America primarily, which is setting the sentiment for the world. The S&P index ended up gaining 14 points on the week. Wasn't nearly as big as other periods, but it was just consistent, just session after session after session, the market hitting new highs, and obviously closed within just a couple of points of a new all-time high. Reporting season has continued along in the same fashion that it has done for the whole season since the start of early October, and a very high level of stocks, high percentage of stocks are beating the analyst expectations and producing some really quite stunning growth rates in earnings as well. So I see absolutely no reason why the rally in America won't continue through into Christmas and into the new year. Now, it doesn't mean it just goes straight up day after day, of course. There could be a little bit of volatility. In fact, my base assumption for the next few years is that we are going to see a higher level of volatility than what we've seen over the last couple of years, but that the direction is to the upside. Now, European indices, I've been saying this now for a month or two. The German Daxx is in a phase 4 decline, but obviously has also rebounded quite strongly and is not far away from me having to change my stance on the fact that it's in a phase 4 decline. But from my perspective, it's living on stimulus alone. There's nothing really fundamentally driving the market higher, and that makes it extremely risky. Whereas in America, the market is going up for really good, solid, fundamental reasons. It's not going up just because of stimulus. So as I've been saying for the last few weeks, the German index needs to close above 9,500 to negate the case that I've made here, which is that the German market is in a bear market phase 4 decline. Same situation with the FTSE as well. Also confirmed it's into phase 4 using the patterns and the rules that I use. But if it did close above 67.50, then that would negate that scenario. So let's have a look at some of these charts. We'll start first of all with the S&P index. I'll just get rid of these crosshairs because they can be a little bit annoying. So you can see the S&P plunged fairly inexplicably because there really weren't any fundamental reasons why it should decline, and as a consequence has just rebounded back. Now, you notice that the daily ranges are getting a bit smaller. They're not as long as they were down here when the rebound first started, but there's still no signs yet of anything untoward. The market getting a little bit overbought, so we might see a bit of a short-term pullback, but look, I don't think it's going to amount to very much. And if you look at the Russell 2000, which is a good indicator, it really got into a phase 4 decline because it went below these previous significant lows. It spent a number of weeks below the 150-day moving average, which had also rolled over. So the way that I read these, that was definitely a phase 4 decline. However, it's been chopped off and it's rebounded, as it should, because, frankly, the fundamentals did not support the Russell 2000 being in a phase 4 decline. So I don't quite know what drove that, but it would appear as though it's finished for now. If we look at the German Daxx, you can see that it's been under the moving average almost the entire time now since about July. Moving average has rolled over. We really need to close back above it, which is, the 9,500 area or just above to negate what I have said previously. Same pattern with the FTSE index as well. Just while I'm here, let's look at the Australian index. This is the ASX 200 just for the heck of it, because I think it's a pretty meaningless index. You may as well just look at the banking index and be done with it. Quite a strong rebound. As you can see, we've gone through 3 Fibonacci retracement levels, so there's quite a lot of strength here. And if you look at the banking index, it's virtually the same thing. And we'll just have a quick look at the materials index. So this is BHP and Rio, and you can see clearly a very different pattern there altogether. So the Aussie stocks, our market gain just 23 points on the week, mostly in the banks. The banks' valuations are not sustainable in my view. Doesn't mean that the share price will come down, but the valuations are at the absolute peak end at a time when there's a lot of things going against the banks being able to continue to increase their profits and increase their dividends. So for me, yeah, they might pay a 5% dividend yield, and yes, the share price might go up a bit further, but in terms of value, it's not even close. And as a general statement in the Australian market, value is tough to find. If you want a high growth company that's going to grow pretty reliably, then, with low risk associated with that growth, then it's very, very tough to buy them for less than 20, 25, 30 times earnings. And that's not really value at all. Turning to commodities now, gold has copped an absolute pasting over the last few weeks, and there was pretty high volatility during the week, and it plunged quite significantly. But equally, it rebounded in the latter half of the week as well. So it actually ended up $5 higher for the week. Stock indices got absolutely smashed, and then they rebounded very, very strongly. And that started before the turnaround in gold, which is, what you want to see. I can't get a good enough feeling around gold and gold stocks at the moment to say that the bottom is in. I think we could see lower levels. The reason being, part of the reason that gold and gold stocks are going down is because the US dollar is going up, and it's hard to see that trend is going to change. We'll have a look at the US dollar index as well. And as I've been saying, silver has been a candidate for short selling since it broke support around $19. So let's look at the gold charts. In fact, let's look at the US dollar index first, because that's a good part of the reason that gold is doing what it's doing. So if we pan back and take a good broad picture look, you can see that the US dollar index has been in a very large range for some time. We've got resistance. We're going to have some resistance up here around these sort of levels. So we're not that far away from it, but it's been a very powerful run from around 80, and now we're closing in on 89. That's been a huge move, and that's a good part of the reason why gold has declined as much as it has. It's not the only reason, but it's a good part of it. Now let's have a look at gold. This is gold on a daily basis, and you can see it was a very powerful rebound on Friday night. But if we look from oversold, but if we look at the weekly, it gives you a bit of a different perspective. We've broken an important support level. The next support level comes in around about 1,020. Now, yes, we had a bit of a rebound, but that always happens, or doesn't always happen, but happens a lot. We get a break of support, and then the market will rally back up to that support, which then becomes resistance. And I think it's probably better than 50-50 bet that gold will roll over and perhaps have another leg down. This is the GDX index. You can see we had a bit of a turnaround on Thursday night, and then it really blasted up on Friday night. And let's look at the junior index, the same pattern there as well. So it's really a bit hard to call with gold at the moment. I would just leave it alone, frankly. I just think it's too dangerous. Now, copper has remained steady at around 307 over the last couple of weeks, but it's in a big overall downtrending triangle, so it does look weak. Crude oil slipped further, did rebound a bit on Friday night, but ended the week at 79, but I think was down around 76 at one stage. But as with gold, we're getting a big rebound in US oil stocks in the last 2 days, and that's possibly signaling a medium-term low for crude oil. So keep an eye on that one. This is the 6-month copper chart. We've just been in this range between $3 and $3.10 now since late September. Nickel in a bit of a medium-term downtrend. And just to wrap it up, the overall strategic approach, of course, remains unchanged. These things don't change every week. And that approach is that, in my opinion, you should have a heavy emphasis on the key US sectors that members of specialist share education know all about and are actively involved in those sectors and those stocks. And there's also some possibilities of picking off some grossly oversold and financially robust stocks. And there's a few of those in the oil sector where, with these good companies that have been probably unduly sold off. So that's where the opportunities lie, and value and opportunity pretty tough to find in Australia. So if anyone would like to communicate with me about their trading or investing, there's my email address. Please feel free to do so, and talk to you next weekend. Cheers.